Alright, welcome to the Legend Finance Academy. Let's get started with the investing thing. Investing is key to financial success. If you don't invest to build a nest egg and accomplish financial goals, you'll have nothing to show for a lifetime of labor. Of course, you don't want to invest your money just anywhere. You need to be smart about what you invest in so you can grow your wealth and become financially free. To make sure you invest in the right way, here are 3 investing rules you should know by heart. Never put the money you'll need in risk. While investing is essential, you don't want to invest every spare dollar. You need some liquid assets or accessible cash. Some investments require you to tie up money for months or years to earn returns, and withdrawing early can trigger penalties. For other assets, such as stocks, you want to be able to leave money invested to weather downturns. Liquid assets, which include cash and anything that can be quickly sold and turned into cash, carry one set of risks, while other assets carry risks because of the time it would take to convert or sell them. As an investor, you should be able to manage liquidity risk to avoid the problems it brings. Otherwise, if you need cash to pay off a debt, make a major purchase, or pursue a new investment opportunity, you cannot access the money quickly. Liquidity risk also refers to the chance that you won't be able to sell an asset quickly when its value reaches a certain point. The time delay in selling certain assets can be a problem if the value falls before you can sell, reducing the amount you earn from the transaction. Every investment carries some risk of losing value. It's essential for an individual investor to have the risk tolerance capacity. No matter you are an ultra-conservative or an aggressive investor, moderate allocation models will always keep your money safe. Moderate allocation models often contain significant quantities of bonds, which aren't as risky as stocks, but offer better returns than cash securities. Regardless of their primary objective, many investors allocate their holdings among all 3 classes of assets. For example, an aggressive investor may mitigate principal risk by holding a small amount of cash in bonds. Don't invest in anything you don't understand. It may seem like common sense for people not to invest in things they don't understand. Unfortunately, it happens a lot. The thousands of investors who bought mortgage-backed securities during the 2017 housing bubble are an excellent example of this type of behavior. Investors had no idea many of those securities contained such low-quality loans. Technology and biotechnology companies often have products or services that require a high level of expertise to understand. For example, unless an investor specializes in electrical engineering, software development, or another related field, it may be extremely difficult to understand a cloud services company's new line of product offerings. Taking calculated risks requires you to actually understand both the potential reward and the likelihood of loss. That means you need to know how the investment will make you money, whether the asset has a history of providing promised returns, and how losses could happen. Unfortunately, too many investors jump on bandwagons without knowing why. Buffett famously said he has 3 boxes for investment ideas: in, out, and too hard. If a company's business or product is too difficult to understand, it's better to just file it in the too hard category and move on to another opportunity. The risk of leverage. Trading using leverage is trading on credit by depositing a small amount of cash and then borrowing a more substantial amount of cash. Most amateur traders, like buy and hold traders, trade using cash, meaning that if they want to buy $10,000 worth of stock, they must have $10,000 in cash in their trading account. Professional traders trade using leverage, meaning that if they want to buy $10,000 worth of stock, they only need a small percentage of the amount that they want to trade. The actual size of leverage can vary from as low as 1 to 2, to 1 to 500, or even higher. This essentially allows market participants to magnify their potential winnings and consequently earn higher payouts. The leverage essentially has 2 sides of the same coin. It gives a trader an opportunity to trade with large amounts of money with smaller deposits and potentially earn high returns. However, on the other hand, just like it increases potential payouts, it can also magnify losses, and even in some cases wipe out the entire trading account. Technically, brokers allow you to open an account with only $25 does not mean you should. Most new traders who open a trading account with the bare minimum deposit do so because they don't completely understand what the terms leverage and margin really are and how it affects their trading. It's crucial that you're fully aware and free of ignorance of the significance of trading with leverage. If you don't really understand leverage and margin, don't be surprised when you blow your trading account. Hopefully this was a reasonable introduction of the basic rules of investing. If you have more questions about exactly what to do or anything about money, do leave a comment in the video description area. Thank you so much for watching. If you want to know more about investing, please subscribe and click that little bell button to make sure you don't miss out. Good luck with investing and see you in the next video. Bye bye.